Trump's trade war is designed to break China's export-driven growth model. The US has the upper hand in the trade war, but China has time on its side. Trump won the first round, but the second round is just getting started. What are the biggest tail risks in the world right now? Why is gold the best hedge against them? Just hours after Trump's reciprocal tariffs went into effect, he announced a 90-day suspension during which only a 10% tariff would apply. Except for China. Not only China would not be exempted from the suspension, Trump raised the tariff even further to 125%. In last week's video, I speculated that China was the main target of Trump's global trade war. Trump's latest move proved me right. I also speculated that the architects of Trump's trade war wanted to inflict a blow to China so big that China would no longer pose a threat to US hegemony. Whether US hegemony is safer or not under Trump, given the estimated price elasticity of US imports from China, the 125% tariff on Chinese imports would decimate China's share of US imports over time. Was Trump's trade war a trap for China? I don't know. But Scott Besson certainly provided fodder to the conspiracy theorists by suggesting that Trump might have goaded China into a bad position. I said a few weeks ago that the DeepSeek news have strengthened the hands of the China hawks inside the Trump administration, who see China as an existential threat that must be dealt with urgently. The Rewe Unbound Cold War II survey shows that nearly a quarter of Americans now see China as an enemy, with another 20% who view China as an adversary. By focusing his trade war on China, Trump has conveniently silenced many critics of his trade war at home. Whether it's all part of a grand plan or not, I think it is not unfair to say Trump won round one. But what about round two? Round two will be all about how China will respond. If Trump's trade war has succeeded in one thing, it is in isolating China. Even before the latest events, Japan and South Korea had denied that they were in discussions with Beijing regarding a free trade agreement. Australia rejected China's offer to join hands. India is said to have turned down a call for cooperation, and Brazil, another BRICS member, said it is not considering any tariff measures against the US for now. Even the European Union, smelling the shift in the air, has decided to pause its retaliatory response to Trump's steel and aluminum tariff. So this has left just China versus the US in the ring. Mano a mano. There were talks in the bond market earlier this week that China was unwinding its US Treasury holdings. Whether this is true or not, most of China's US Treasury securities are held with the New York Fed. If Beijing is even contemplating liquidating them, which I doubt, it cannot rule out that its account could be frozen before long. The large trade imbalance between China and the US means the US has the clear upper hand in the trade war. China has been cutting back its imports from the US over the past few years. Last year, China accounted for just 20% of US soybean exports. In other words, China's economic options to force Trump to back down are not great. All China can do to offset the loss of US exports is by stimulating domestic consumption. Even though China's leverage ratio is already one of the highest in the world, given the inflation is extremely low, China has plenty of room to ease monetary and fiscal policies. Indeed, my prediction is that Beijing will soon embark on major fiscal and monetary expansion that might even include QE to stave off a potential deflationary cycle. This is what I'm thinking. Right now, the US has the upper hand. But time is on China's side, especially given Trump's declining approval rating. We should assume that each side will try to play to its own advantage. I expect Xi Jinping will try to play the long game. But he has two other choices. He can accept defeat and sue for peace, or he can try to punch back and get even. But defeat won't be easy to swallow. Trump will likely demand large sustained Chinese purchases of U.S. goods, increase access to Chinese markets by U.S. firms, cessation of Chinese oil imports from Iran, and China's agreement to sell TikTok to the U.S. Even if Xi were to agree to these demands, there is no guarantee that Trump will drop his tariff soon. Indeed, Trump did not lower his 25% tariff following the Phase 1 trade agreement signed between China and the U.S. in 2020. There's also a good chance that China's other trading partners, such as the European Union, might try to piggyback on any deal the U.S. manages to extract from China. Surrender by Beijing would also be a blow to the personal prestige and credibility of Xi Jinping, whose industrial policies and nationalist program has set China on a collision course with the U.S. Given the way things have gone over the past month, I'm not too optimistic there will be a Phase 2 deal anytime soon. If surrender is not in the cards, will Xi decide to escalate and punch back in some ways? Here lies the tail risks for financial markets in my view. Where does China have leverage? How might Beijing inflict pain on Trump? Iran immediately comes to mind. China is the largest buyer of Iranian oil. As long as China is willing to keep buying Iranian oil, Trump's sanctions on Iranian oil exports will have limited impact. Harvard's Graham Allison has made a convincing case that Japan's attack on Pearl Harbor in 1941 was a reaction to the announcement of a U.S. oil embargo that would have crippled the Japanese economy. China's alliance with Iran and its expansion in South China Sea are likely intended to preserve its access to oil in a future conflict with the U.S. It is safe to assume that the escalating tension with the U.S. is making Iran an even more important strategic partner for China. This in turn is further reducing the incentive of Tehran to give in to Trump's ultimatum. In this respect, Trump's new trade war on China has considerably increased geopolitical risk in the Middle East. An open confrontation between the U.S. and China over Iran would be, of course, nothing compared to an open confrontation between the U.S. and China over Taiwan. Could Trump drive a desperate China into imposing a blockade on Taiwan? Whatever the probability of China making a move on Taiwan, surely it is higher this week compared to last week. The shares of both the Chinese and Taiwanese respondents in the Unbound military risk survey, who think that the military tension between the two will intensify in the coming weeks, have surged over the past month. They are indeed near the highest levels recorded by our survey over the past 3 years. A blockade of Taiwan would be China's ultimate retaliatory response to Trump's trade war. Chips manufactured by Taiwan's TSMC power iPhones and Microsoft's data centers and keep Lockheed Martin's F-35s in the air. In other words, even a temporary blockade would have a very negative impact on the U.S. IT industry, defense industry, and many other industries. What the past 2 weeks have proved is that the U.S. stock market has the final say on what Trump can do. With the stock market already walking on eggshells, it is enough for the market to think there is a possibility of a disruption of TSMC chips for the market to drag the U.S. economy into a recession. Whether Beijing will play this card or not, there's no denying that it is a powerful card that the U.S. currently does not have an answer to. Unless, of course, Trump is prepared to go to war with China. Trump is pressuring TSMC to move its manufacturing capabilities to the U.S. But this will take years, even in the most optimistic scenario. Trump might have won round 1, but round 2 is just getting started. My prediction is that round 2 is potentially much riskier than round 1, as economic risk will be compounded by geopolitical risks. My guess is that in round 2, the world economy will go into a recession, the RMB will do poorly, defense contractors will outperform, and gold will shine brightly. Thank you for listening.